Welcome to not another lunch and learn. We are kicking off, just getting everything set up as usual. All right, let me share my screen. All right, we should be live on Facebook. We're live on Instagram. So thank you for being here today. Today we are discussing the Inflation Reduction Act with Seth from Focus Companies. So he'll be on here in a minute and we'll introduce him, get to know about Seth a little bit. And but first, we will do what we usually do, another lunch and learn every Wednesday at noon to 1 o'clock, free event, virtual, Facebook, Instagram, or you can register if you're a member within our website, and you can be on the Zoom call and ask questions within the chat. If you're just logging on Facebook or Instagram, pop your questions in the comments. Molly will be there to get the questions over to me. So let's kick it off here at Azria. As you know, you could always follow us on Facebook, Instagram, YouTube, LinkedIn, anywhere on social media. We are there. So check out our handles on the bottom. Our purpose here at Azria is to support, educate, and provide networking opportunities to all real estate investors throughout the state of Arizona. We've been doing so for 20 years strong. So love that you're here with us today. Like I said, we're going to be talking about the Inflation Reduction Act with Seth at Focus Companies. So I'm going to take a few minutes first and just kind of let everyone know what we have going on here at Azria, so you're in the know. So October 10th, Monday, the second Monday of every month, we do our Phoenix monthly meeting. This is the big meeting where all members from all over come out. All our business associates come out. We have a trade show. At that trade show, we also, outside of that, we have our market update. We have Tina Tambor coming in October for that event. And this is going to be at the venue 8600 in North Scottsdale. So we'll do our association update, the market update with Tina. Then we have a special panel that we will be putting together with 4 individuals that are masters at their craft in the real estate investing world, surviving a real estate transition. So we have Steve Trang of the Real Estate Disruptors podcast. We have Zach Keeps, major landlord in town, over 250 rentals. We got Brian Kindeski, who's doing 5 to 10 flips a month, and we got Andrew over at People's Mortgage, who has over 400 loan products, and he's going to tell you what he's seeing with the interest rates and how the investment loans are going. So big meeting, definitely need to be there. But then we drive down to Tucson for our Tucson chapter and do the same thing the next day. Then what we like to say here at Azria is you learn so much information, about different strategies, the market. You meet so many new people, you're bombarded with all this knowledge. So we want you to take that knowledge, come down to the Phoenix Real Estate Club Tuesday, September 27th, 4th Tuesday of every month. This group is held at our office here in Central Phoenix on 16th Street in Highland. So this is where we get more in depth, it's more intimate, more discussions about the market. Investors are letting us know what they're seeing in the market. They let you know what kind of deals that they're doing in today's market and how they're adapting and sharing resources and everything and so on. So definitely make it to Tuesday, September 27th. Let's see here. Hey, Molly, are we on Facebook? Are we good? I don't see the logo up here. Okay, I think it is. We'll figure that out. So subgroup meetings, this is a very important part of real estate investing, is networking. Okay, so outside of our monthly meeting and our training classes, we do have our subgroup meetings that are held we have almost 15 to 20 events a month. So as you can see, we have all these different events that go to all different categories of real estate investing. All right, here's what I'm doing. I am Instagram just went off, so I'm getting Instagram back up. Sorry about that. We improvise and do what we have to do as we go. So here we go. All right, so back on Instagram. So subgroup meetings, 15 a month. Okay, here's some of them that we have. Check the calendar, azria.org/calendar. You can see when these events happen. They're usually on the same date every month. So next week, I know we got, like I said, the Phoenix Real Estate Club on Tuesday. Then on Wednesday, we have the Fix and Flip group coming up. Then the following week, I know we got the buy and hold group coming. So we just added a new group in Bisbee, Arizona. So if you're south of Tucson, you want to know what's going on in that market. I know there's affordability issue, there's a housing supply issue. So they're there to keep you informed in southern Arizona. The women's group will be on coming back. Just started this last month. Great turnout. That'll be back in the beginning of October. And tomorrow, Molly has the discovery session. So if you're new to ASREA or you're noticing a lot of changes within ASREA and you want to be informed as what's going on, Molly spends an hour of her day Friday at noon on Zoom, free event. Register so you get the Zoom link, and she'll answer any questions about ASREA that you have. All right. So check our calendar out. Forums. This is a new feature that we added to our website. So definitely check it out. Outside of meeting in person, we want you to be able to network with other members and gather resources and knowledge outside of the in-person meetings. So last month we added the forums, 24/7 access, network online. We even added a property posting section. So if you're looking to buy property, off-market properties, you're looking to sell a property you own or have under contract, go to our forums and post that in there. It's for members only. So definitely check that out. This weekend, Saturday, September 24th, we are having special guest Anthony Chara here. He was with us last week at our monthly meeting in Phoenix and Tucson. He did an awesome drill down session. Wednesday night at 6:00, where we just analyzed deals for 2 hours. So that was an awesome experience. So he's coming back this Saturday, full day, 9 to 5 here at the office here in Phoenix. And he's taking a deep dive in building wealth with apartments and multifamily units. He's owned over 2,000 units. He's still buying. He buys all around the country. So if you have a deal you want him to analyze or check out, he could probably do that later in the day. But we're going to get a workbook, and you're going to just learn how to invest in multifamily. So since you are on this lunch and learn right now, and as always, when you attend ASREA events, you get the best pricing. So tonight, for up until 5:00 tonight, because we need to build out all the workbooks. So $109 for members, $139 for non-members. Price will go up after tonight to $169 and $199 if you show up day of. Okay. So September 24th, go to our calendar, make sure to register as fast as you can. And let's see where it says. All right. Next we have, there we go, Launchpad. If you are new to real estate investing, you don't know what you're doing, you don't know where you're going, you can kill a lot of time and waste a lot of time and end up a year down the road and not have anything accomplished. So the Launchpad was created by Alan Lakeson about 5 years ago. He's interviewed and built a basic business plan with hundreds and hundreds of members. So he perfected this Launchpad group session. So you will leave the class with these 8 objectives clearly defined. What kind of investor are you? You need to know, you're jumping around right now. Should I do a subject to? It's not even a subject to, isn't even like it's a strategy within real estate. So it's just a tool. Are you a landlord? People get confused as to what they are and what they're trying to do. Narrow in who your investor identity is and who you are as an investor. Then you could build a plan and work towards that goal. So we want to help you achieve that. Oh man, we're missing a slide. So this, if you go to, it's $30 for members, $100 for non-members. It's a very important class. There's a hint there as to why we're doing it for $100 for non-members. So I'd love to see you October 29th, Saturday, at the Launchpad session. Core classes. I always ask this question: when Tiger Woods and Jack Nicklaus, golf legends, first met, what was their first conversation they had? Does anyone know? Does anyone want to throw it in there? They talked about the grip of their golf club. They didn't talk about the tours they won. They didn't talk about their trophies and all their successes. They talked about the fundamentals. One of the most fundamental things that you could do in not real estate, golf, is how do you hold the club? So in real estate, we have 5 fundamentals in order to succeed in real estate and be able to get your deals done or be better at those deals. It is these 5 pillars: marketing, getting leads into your business, analyzing the deal, right? You got to know what it's worth and you got to know what the repairs are so you can write that offer So you need to negotiate that offer, right? With whether it's a wholesaler, agent, or direct to the homeowner, you want to make sure you get that best price to get the most margin on your deal. So having some basic negotiation skills is important, because when they say yes to that offer, you need a contract. We have Mick McGurr of Phocus Law coming in. He's going to talk about all the contract basics. We're going to provide some free contracts for you to use. And he's going to clarify any myths about contracts or getting in trouble, or whatever fears someone may have. And once you lock in that contract, you got to have the money. How you going to fund a deal? Every real estate deal includes money. It doesn't have to be your money. So Andrew at People's Mortgage is going to come down and talk to you about all the investor loan products that are out there in the market. I'll spend some time talking about doing some raising capital, some private joint ventures and stuff like that. So there's 10 hours of education here once a week, every week for the next 5 weeks. We will sell that bundle online or in person for $150 because you're on this call. So you just have to go to our calendar. You'll see the marketing class starting September 29th. If you just go into that marketing registration page, it'll give you an option to buy all 5. Okay, so that's still available as of right now. So check out the core classes, get your fundamentals in. Asria show every week, Friday at 7 a.m. Me and Marcus have been doing this show for 43 episodes now, gaining a lot of traction, a lot of listeners, a lot of questions. So I thank you everybody for supporting. We had the Fire Damage King, Elijah, on there last week. So check him out. He was also on our Lunch and Learn a couple weeks ago. If you look back, he talks about locating fire damaged properties. As members, we have the largest Home Depot discount in the country. So just as being a member of Asria in itself, you get 2% cash back twice a year. Okay, so you're getting money back when you're returning over your rental properties, you're flipping these properties. Every time you go to Home Depot, you're getting rewarded, as well as you're getting 20% off all your liquids, right? Appliance discounts, cabinet discounts. So like it's all about the margin and the bottom line, and Home Depot and Asria do that for you. So make sure you have that connected properly. If you don't have your Home Depot and Pro account set up with Asria correctly, we have a video in our membership hub, as well as Molly will answer those questions on Friday for you. To become a member, very simple, $100 a year. Super affordable. You pay $5 for each meeting, networking group, $10 for the main meeting. Okay, if you're not going to be highly active, this is what I suggest. If you're going to be highly active, you can go all in. You're going to more than 7-8 events a year. You need to become a Plus member. Both programs provide all benefits that Asria offers. We have 30-40 vendors nationwide and local. It's not just Home Depot that you get a discount at. You get with lenders, hard money lenders, title companies. You get discounts for being an Asria member at all those places that support real estate investing. Next week, we have our good friend Patrick Allen, our Asria subgroup leader in Tucson, and we're going to discuss why house hacking is the best way to start investing. So make sure to register for next week. With all that being said, we have our good friend Seth here. And also, just so you know, any of the classes you've seen, Molly's been dropping the links inside the chat here on Zoom. So if you just want to go straight to the calendar invites on those classes or read more about them, they are in the chat. And if there's any questions before we get kicked off, or if there's any questions that we have for Seth, if you want to start popping those in on Facebook, on Instagram, or in the chat, we will get those answered for you. Seth, my man. Hey, last time we seen, you didn't have hair on your face. Is it?
No, sir. That's a newer happening for this year. So yeah,
Love it, man. Looks good.
I can't grow it here, so we're just gonna let it go here. Yeah,
I'm with you on that. That's why I got a hat on. Don't let me fool you.
I apologize for being late coming in. The link wasn't working, so I finally got it sent. So we're good to go.
All good, yeah, man. I definitely can't answer these questions, so I need the pro. So if you guys don't know, Seth here is Focus Companies is one of our business associates here. So they're handling, if you got your LLC done, Mick probably handled that. If you've done any estate planning, Sam probably helped you out with that. But we have Seth here, who's in their tax department. So he's a pro at this in this part of the world. So Seth, before I ask you to tell us about yourself, Tell us about yourself and how how you came about in Focus and got all this experience. And then I have a question before we kick off the Inflation Reduction Act.
All right, perfect. Thank you so much, Mike. Our firm actually started back in 1978, which you guys can see on there. My dad started the firm as an unenrolled preparer, specializing in small business and individuals. I came on board with him in 2004. We at that point turned it into a CPA firm. He was never licensed, and we wanted to take the opportunity to really grow the firm and enhance what we do. My partner, Clay Jansen, and I started the Focus Companies brand in 2009. He's another second generation business owner. We put our forces together and formed a holistic planning firm for Focus Companies. And little by little, we've been adding other services and departments, like, Meg with Phocus Law. He is part of the group that we added on in 2017. So we have health benefits and health and liability insurance. All the things that you guys do, we have all under one roof. Over the years, actually since the mid 2000s, we've had the opportunity to start working with a lot of real estate agents. And with that, real estate has become our biggest client base that we have. So we work with agents, brokers, investors, and developers. So the taxation techniques that are specific to real estate agents, the ones that are specific to real estate investors, are things that we focus on, things that we have the expertise in, and we coach and train people how to do it the right way. Whether it's entity structuring, whether it's what kind of expenses you can deduct, and just the presentation of how all that goes. It's turned out to be a huge part of our firm and what we do in helping clients.
Awesome, man. Well, great intro. Yes, you guys are well respected. I know you guys been with us for maybe a couple years now. Our members love you guys. So before we jump into the Inflation Act, I just want to throw out there. It's 4th of July, everybody. This is a good time to do a lot of your tax planning for businesses and all the strategies that Seth was just mentioning. Don't wait till January, February, March, all that stuff. So jump in there now. And if you're doing good, Seth, right, and you got some money, you're looking for some ways to be creative on your taxes. And I'm just relating this because we have a lot of members. There's a lot of events, a lot of knowledge. Like, what can't this all be write-offs? Like all these classes they're going to and becoming a member and whatever. If it's other events and what are those write-offs, like education and networking?
Certainly. So the hard part is always when you get started with that very first property, that first passive, investment property. It's really difficult from a presentation standpoint, to include all those other business related expenses, right? Yeah. So often what we see do is our real estate investors will form an LLC. That's like a holding company for all of their properties. And in that holding company, it is in the business of managing real estate investments. And then they'll take those deductions there. So things like professional development, memberships and dues, kind of the non-direct real estate property expenses gives them a place to have all those there. Like if you have one property, you'd have a really hard time taking a tax deduction for actual expenses for a vehicle because you can't justify the amount it would be used. But if you have 5 or 6 properties and you have a parent entity running all that, well, now the utilization of the actual expense of a vehicle is much easier to justify with having a volume of properties to manage. So it's kind of an economy of scale that you look at, but the bigger your real estate investment portfolio gets, the easier it is to justify more of those indirect expenses for managing your real estate life.
Awesome, man. Thank you for dropping that, man. So we'll jump in. It's 12:23. We roll to like 12:50, 12:55, and then we allow questions hopping in. So if I see any questions, I might interrupt you here and there. So, what's the Inflation Reduction Act? Let's start there. The reason I wanted you on was maybe just kind of say, how do we prepare to I heard the 87,000 IRA or IRS agents, like what are some ways we could prepare, protect ourselves? And I know there's some like, energy credits, and there's probably some credits for investors and stuff like that. Maybe just kind of go along those lines.
Certainly. So one of the things I can do for you when we're done, Mike, is I can send you this great synopsis that I got of the act. I can forward it to you. That way you can share it with your members. It's actually from a CPE class I was taking, but it's great. It gives a lot of good information on putting this together directly for real estate investors and the people that, that are in your audience here, there's not a ton that directly applies, right? Most of what's included in this act are things about alternative minimum tax for large corporations, changing the vehicle credits for electric vehicles, and some things like that. There's obviously some criterion here I was looking over, drug costs and capping those and some things like that. Those are important to people, but it's not real specific to what you're doing. The residential energy property credits for solar are always sticky when it comes to real estate investors because the credits are only intended to be for a primary residence. Okay, so there are other ways to accomplish it through other means. I know some folks that have put together businesses where they actually lease solar and they get the credits. So when you lease a solar system, you actually can't get the credit from the IRS. It's the owner of the project would actually get that. So the credit actually goes back up to 30% for this year for the next 12 years through January of 2033, so 11 years. And then it'll start going back to 26 and 22%. I anticipate they're going to continue to push this down the road. So we thought it was going to start to sunset, and this act just gave us another 10 years of runway at the 30% credit level, which is pretty crazy. Now, when you do qualify for a solar energy credit on an investment property, it does change the deductibility. So, for example, if the government gives you, if you spend $70,000 on a solar system and the government gives you a $20,000 credit, I'm just doing simple math, then your deduction for depreciation starts at $50,000. So if you qualify for a credit, you don't get to depreciate the entire cost of that system. You have to reduce it by the credit. Same thing works for electric vehicles. If you have one in your business that qualifies for a credit, you would actually reduce the depreciable base by that amount. Right. I think the thing that scares most folks when it comes to this act is just what you're talking about. It's the IRS. It is, what does this mean? What does 87,000 additional staff members at the most hated organization on the planet mean to average people? Well, if you listen to what the government shares versus what we hear and we read, they're very different stories. The government wants us to believe that they're targeting individuals, families over 400,000 of income, or business owners primarily over 400,000 of income. But if you talk to former auditors, they'll tell you that higher income people are generally more apt to hire a CPA or a tax attorney to defend themselves. They really go after, historically, and this is sadly, there's statistics to back this up. They go after taxpayers generally who can't defend themselves, or they know it's the easiest low-hanging fruit. The people they know that they're going to be able to get recovery from with the least amount of cost to get it. Because that's what the IRS does. It's the cost benefit. What does it cost us to go after this taxpayer? What do we think we can recover? And is there a margin for us to achieve in this?
Wow.
So a majority of the new staff they're hiring are regular, revenue officers. There's going to be revenue agents, which are those people that we're all scared to believe that their IRS has people with badges and guns, just like the FBI and the CIA. Their job is more seizures. So they'll go on site with federal law enforcement seizing property. Things have to get pretty bad forever to get to that point. Yeah. But a majority of what they're bringing on board is revenue officers, and their job is to go out and audit. Our client base being small business owners, we are the primary target.
Okay.
There's absolutely no doubt that they're kind of targeting those middle income business owners because they either tend to not use a professional and not quite know what they're doing, whether it's intentional or not, or a little bit larger small business owners, because really, really big ones tend to have a fleet of tax attorneys and all the other people behind them. And the IRS knows that their recovery rate's a lot smaller. One of the statistics I was reading, that in tax court, so if you get audited and you don't like the result, you can appeal it and take it to tax court. The IRS is under 50% in their win rate in tax court. And what that tells you is, if you apply that statistic to all audits, which it's kind of hard to do, but just go with it for a moment, that would tell you that more often than not, the IRS is wrong in an audit. So they have built a system that is guilty until proven innocent. They send you a letter, say, hey, you owe us this money unless you prove otherwise. It's not, they say it's not an assessment yet, it's an inquiry, but there you have to sit and prove why do you not owe them that. So for
It's crazy you said. Me personally, we had a payment that we made, like our quarterly, payments you make in advance. But the check was accepted and they cashed it, and I have proof of it. And they're like, well, we don't have it. So they told me we got to call them. We got to call them, get them on the phone. So I got to wait 2 hours, get them on the phone. Then once they're on the phone, pull up my file, then be in front of a fax machine and fax them the receipt of proof. Dude, I'm like, what the, like, innocent or guilty till proven innocent, man. I was like, right. The money's out the count.
Right. And so, unfortunately, this has been going on in earnest since 2020. So when the 19 filing season pushed into 2020 in the pandemic, when all those IRS people started working from home too, that's when things got from really bad with them to incredibly worse. Just like you're stating, that's 100% accurate. Clients make their payments. They don't get it posted. The client gets a notice saying, hey, you owe us money. Like, no, but I paid it. Here's the proof. It's up to you to go and prove it. Then they have to go and try and find the payment. Most often, if you mail payments these days, it can take as much as 6 months to get posted to your account. And now we were telling clients, do the online payment. There's a direct pay. There's literally a link. You can go and have the money taken in your bank account. And they're delayed at processing those too now. They take your money right away, but they don't give you credit. So there's often quite substantial delays between, hey, I filed, hey, I paid, the IRS thinks you didn't. And it could take 5 to 6 months to reconcile those. So.
Wow. So really, so briefly, like on the Inflation Reduction Act. So what was the whole idea of this? Like, why did they put this together?
Well, a lot of this, if you look at it, is energy related. Energy and alternative minimum tax are their two things. So the Tax Cut and Jobs Act that was passed by Congress the end of 2017, that started to be effective 18, included a 0% alternative minimum tax rate for corporations. And what that did is it took corps, instead of paying their 21% federal tax, they pay 0 because of losses and other things. But the law says if your income is over a certain threshold, there's a minimum tax you're going to pay of 15%. That law abolished it, and this act puts it back. So all your large corporations that can manage to have book losses now have to pay this minimum tax. And that's like the bread and butter of this is from a revenue standpoint, right? And then the second big part was the energy credits. Now they can sell this any way they choose to, because there's other provisions that are really good for seniors, like capping medical expenses and some things like that related to prescriptions, and that's all good. That's just the stuff that got added onto it. The big push was alternative minimum tax, and then expanding and changing the energy credits for electric vehicles, for solar and that sort of thing. And then this push to expand the IRS. Now, the IRS has been understaffed for so long that it's not necessarily a bad thing. It's just kind of the way it's being presented is not great, where they're saying, hey, the recovery the IRS is going to have on their collections is going to pay for this whole thing. And you're like, wow, okay, that's pretty interesting thought. So that's what they're looking for. That's how they're looking to pull this off. So that the whole idea of adding the IRS component to this is just a methodology for paying for all the energy credits and things like that they're doing, along with the alternative minimum tax change for large corporations. So.
Got it. So if there's any questions out there at Facebook, Instagram, in the group, please put them in the chat so we can ask Seth anything that might be on your mind. So Seth, so with all this going on, so as investors, what are some way? How do we prepare? How do we look better on paper? You know what I mean? Just so we don't hit any of these ruffles if the IRS comes, or any suggestions?
Yeah. So what we've started telling our clients, I had already sent a synopsis out to all of our clients, and it's really to be diligent, right? I'm not going to tell people what they can and can't do or should and shouldn't do. The more important part is to be reasonable and prudent with the expenses that you incur and report on your business. I don't care if it's real estate or it's consulting or it's my CPA firm or mixed law firm. It doesn't make a difference. They're going to be looking at what stands out. And so what's always been the biggest hot buttons for the IRS for auditing businesses are vehicle expenses, travel, and meals and entertainment. Those are their favorites that they pick on. Or in some cases, like for like my realtor clients have large, client gifts. Well, technically you only have $25 gift per client. So that's another number they'll pick on in businesses that often do, gifts as a big part of what they do. So it's presentation. It's being thoughtful about those things and making sure you're diligent, making sure if you take somebody out that's business related for lunch or for dinner, you document on the receipt who you went with, what you talked about, and save that receipt. Very important. Every time you use your vehicle for business purposes, if you're managing your own rental property and maybe you're doing some remodeling on it, you're going a couple of times a month to check on it, keep a mileage log. So at the end of the year, when you do your tax return, that mileage is accurate. And that way you can support the deduction that you take on your return. Clients always come to us with estimates. Oh, I drove about this many miles. Well, that's well and good, but it's not accurate. And if you're audited and you can't support the number that you provided on there, it's going to get thrown out. Travel expenses, as it relates to real estate, I have a number of investors that will look for properties in other locations, whether it's in-state or out-of-state. Just documenting those trips is super important. You need to be able to show that you're traveling for a bona fide business purpose. They can't tell you you can't spend your money in your business. What they can do is say, does it relate to your business? Right? Is it justifiable? So if you're an investor in Arizona real estate, you say, I want to build a portfolio in New Mexico. I'm going to take some trips out there and get to know some different places. Document all the intent of what you're doing. That way, if you got audited, you can show them, here's my diary. Here's what I've done. Here's where I've gone. Here's who I visited. Here's the agents I spoke to there, all the other stuff. And then you're good. Then they can't tell you that it's not a viable deduction. It's up to you as the taxpayer to be able to show the link between what you did and how it relates to your business, and it's a bona fide business purpose, right?
What about people like me, Seth? That receipt goes in my back pocket. Receipt again.
Doing that. So here's a real simple solution. There's an app. It is free. It is called Smart Receipts.
Okay.
And it's on your cell phone. And what you do is you'll actually take a picture of that receipt in the app. And then you actually put in all the details on it. So you put in the date, where you went, was it lunch, breakfast, lunch, dinner, supplies, whatever code you want to, and saves it. And then once a month, then you can throw the receipt away. The IRS does not require you to keep a paper receipt. They just make sure you can have a digital facsimile. That's totally okay. Then once a month, you email a PDF of all those receipts to yourself, archive it on your computer, make sure you back it up, archive it on your computer, and now you have all the receipts delineated, documented, categorized, and you're done. And it takes literally a minute every time you use one. You print the receipt, you take the picture, put it in, done.
There you go.
Super easy.
Love it, man. Yeah, because I've seen things where I've saved receipts in the past and like they disappear, right? Like the information disappears. So this stuff you have to do, whether you like it or not, as a business owner, right? Eventually you could probably there's always software out there, right? And there's bookkeepers and accountants and so on as you grow. Right. Yeah, but TurboTax ain't doing this for you, right?
No, it isn't. And the IRS, they've changed their guidance from time to time. It used to be $25. Now it's under $75 for an expense. If you don't have the receipt, but you can show where it was paid for on your business credit card or a debit card, you're okay. They're not that they have like a de minimis rule that says, hey, under this dollar amount, we're really not going to bother you too much, right? The exception to that would be meals, right? So just for you guys thinking about this, a deductible meal is not you eating by yourself ever, period. If you're out and about during the day, I'm like, man, I got to go get lunch and I obviously couldn't pack it. So I'm going to go run to Chick-fil-A and get my favorite chicken sandwich. That is not a tax deductible meal. It has to be with somebody, whether it's an employee, a coworker, whether it's a business associate. If you're doing work on your rental property for the day and you say, tell the contractors, hey, come out and I'm going to treat you for lunch. Totally cool, right? But just can't be by yourself. Right. The only time that somebody can take a tax deduction for their own meal alone is if they're greater than 50 miles away from their tax home. So let's say you drive to Flag for the day to go see properties up there and you get lunch while you're traveling for work purposes. Then it is deductible because you're greater than 50 miles from your tax home here in the Metro Phoenix area. So
basically we're saying, dot your I's, cross your T's, paper trail,
Yes. Diligent.
CYA, kind of stuff. What are some other, things that we should like be looking out for? Like, is there red flags that like that maybe we're doing, we just don't know that we're doing wrong, right? Is there any other areas that we got to be looking at besides, tracking expenses and gas?
Yes, I mean, anything in your business you should be tracking, doesn't matter what it is, right? So remember, if you have a business, whether it's a turnkey business, whether it's a rental business, doesn't matter. Every penny you spend in that business is in some facet deductible. Okay. You just have to be diligent on tracking it, making sure you know what it was, what category does it belong to. And the bigger picture I tell folks is pigs get fed, hogs get slaughtered. Just be thoughtful about what it is you're spending and be thoughtful about how it applies. Now, you're remodeling a property, you might spend 10 grand on a bathroom, you might spend 15 grand on the bathroom. The IRS can't tell you spent too much money on that bathroom. So that's not something we worry about. But in the other expenses of your business, they can. They can look at it from a reasonableness standpoint. So a lot of people don't know this, but one of the things the IRS does is when you submit your tax return, there's a 6-digit code on your business. Now, if you are doing a Schedule E for a rental property, it doesn't exist like that. If you're doing a Schedule C or you have a separate partnership or S Corp, there's a 6-digit code on there that tells the IRS what nature of business you're in. Like a real estate agent is 531-210. And what they'll do is they compare everybody with that same code against each other and see what falls out on the fringes. And it's the ones who your ratios of expenses to income fall outside of the average parameters. You're the first one that gets looked at from the IRS perspective, right? Rental properties are a little bit different from the standpoint of, your profit taxable income or your tax deductible loss very well is dictated by how much debt you have. When somebody buys a property at first and they have 20%, down, financing 80%, doing some remodeling to it, it's going to be years before they show a taxable gain, right? Someone who goes in and pays cash for a property, after they kind of overcome the initial expenses to bring that property up to their specs to rent it out, they're going to be showing a profit, in year 2 for sure. So that really has a big impact. But trust me, when they look at those ratios, they're looking at rental properties and they can see, debt to earnings. They can see those sorts of things. So there's no way for a taxpayer to look and say, well, what are the ratios? How do I fit in? They don't tell you, right? So someone like us, where we do this every day, all day, it's a smell test. You can look at it and say, that looks good, or that just doesn't look right. Right.
Interesting. So are you saying like a fix and flipper or a wholesaler, someone just doing volume transactions of cash, they might be kind of targeted in a way or red flagged?
Definitely looked at differently for sure. Gotcha. So because, fix and flips, we typically do those in a separate LLC from your hold properties, right? We never want those to be in the same place. And that kind of a business will be looked at different for sure. 100% versus a hold.
Mm-hmm. Fix and flippers, wholesalers.
Mm-hmm.
Get your stuff in order. Wow.
Right. So here's something to think about. And I'm not sure if you guys have ever talked about this or not, but there's a difference between active and passive businesses, right? So when you're buying real estate to hold and lease, you're a passive business owner. Now, once you have the point where you have enough properties that is like a part-time job or that is your full-time gig, then it becomes an active business. But let's say you have 1 or 2 rental properties. It is a passive business, okay? You're doing fix and flips, that's active. So that active nature of that, meaning I'm participating on a material basis all the time versus, hey, I bought this house, got it up to rent, and now I check on it once a month. So there's a very different dynamic in how the IRS looks at passive versus active businesses, right? Those active businesses can get away with more expenses because it is something that's active. Like if you have 1 rental property and on your Schedule E, I wouldn't want you to put your cell phone expenses on there. We can include a small amount for office expense to kind of cover a little bit of internet, cell phone, those sorts of things, right? But we wouldn't want to put your whole cell phone bill in there because there's no way you can say, hey, my phone cost is 100% for this rental property. Just makes no reasonable sense. But if your full-time gig was flipping real estate and wholesaling real estate, that's another story. You're going to be able to justify using that phone, not 100%, we never do that, but 85, 90% of your costs associated with your business. So the profile changes based on the active versus passive. So you can get away with more of those expenses in an active business, but you will be scrutinized more and compared to other people doing the same thing. So
Great, man. So it sounds like us real estate investors, we should be doing both
Mhm.
anyways, right? If you're flipping and wholesale, making those quick cash, you definitely want to be sinking some of those profits. If you really think about it, this is what Robert Kiyosaki really did, right? He bought big businesses, made big profits, and put it into real estate. He wasn't wholesaling 10 grand, 10 grand, 10 grand. So wherever you're getting that quick cash from, put it in the real estate. So if you're flipping, you still want to be building that rental, that passive income.
Right. And if you reading Rich Dad Poor Dad, right? You know, the 1031 exchange is like the most amazing power in real estate, because that way you keep all your money in the deal. That way you're not having to take money out of the deal to cover taxes on sale. That way you can buy bigger properties and keep growing at a faster pace than you would if you weren't able to qualify for one.
Can you talk on that? Just touch on it briefly. Like, what is it and how does it work?
Certainly. So a 1031 exchange is a way that you can sell appreciated real estate. Now, it works for any investment property. Okay. It can't be your car that you use in your business, right? Because that's not investment property, but you're a rental property, it appreciates. Now, remember, you're also, over the time you own it, you're taking depreciation. So your cost basis, your adjusted basis is coming down. So when you sell that property, all that depreciation comes back, right? So you have this appreciated property. You're like, wow, I don't want to pay taxes on it. I want to go buy another piece of real estate. So the way the 1031 exchange works is you have up to 45 days after you sell the property to identify the property you're going to purchase. And you have 180 days to close on it. Okay. But there's some rules to it. So number one, you have to use a qualified intermediary. That means at that infinitesimal second before your property sells, this intermediary essentially takes title to your property. It doesn't really, but that's kind of how it works. They put all your proceeds in an escrow account for you. Then when you identify and purchase the new property, they initiate that transaction and then they turn the property over to you. You as a consumer, right, as a business owner, cannot touch that money in the middle of that 1031 exchange. Any cash you take out is considered taxable up front. So any taxable portion on that sale comes to you first if you take cash out of the deal. So to make sure you properly protect the 1031 exchange, the property you buy must be at least $1 more than the sale price of the property you sold. Then you'll never have any issue. So if you sold a house for 500 grand, you bought one for 450, the $50,000 difference is taxable, because we figure out how much taxable gain there is, but you don't take a proportion between gain and basis. It's all gain coming out first. When you do that, it's called boot. Okay.
Interesting. That's okay though, right? Like, let's just say we did buy something cheaper than what we made.
Yeah, it's okay.
Good. You just understand you're going to be taxed.
Correct. And it's being able to work through the numbers and make sure that works. Now you can do a 1031 exchange where you buy 2 or 3 properties. So let's say you had a property appreciated, it's worth $1 million. You go and sell it. You can buy 3, $350,000 properties, but you have to fit them in the same timeline: 45-day identification, 180-day close.
Can it be can you switch to product?
It's got to be similar, like to like, right? Okay. Now, I've had people exchange from raw land into finished construction. That's okay, because it's investment property for investment property, but it's still in the real estate world. So it's got to be similar. You could exchange residential into a fractional ownership of a commercial building. We've had clients do that. That totally works. Nothing wrong with that. The biggest part of the 1031 exchange is using that qualified intermediary. They will make sure that the transaction qualifies and is handled accordingly. Someone like us, we make sure that all the math is done correctly and the taxable gain is all done. All the QI does is just make sure that the buy-sell stuff meets the IRS requirements. What I tell everybody is to document their intent. Because I have people approach me all the time saying, well, don't you have to own a property for at least a year to qualify for a 1031 exchange? The answer is not exactly. You could hold a property short of that. So I'll give you an example. I had a client bought a condo, and I told him to paper the file. He said, when the property gets to this value, I'm going to sell it and buy a single family residence rental property. It hit that value in 4 months. It was during 2006, 2007 when things were going cuckoo back then. Mm-hmm. So they sold it, did a 1031, bought a regular residential property. We did it as a 1031 without question, because his intent was to sell it when it hit a certain value.
Love it. Got it. So is that a service you offer, or is that something a third party you have to go? offers 1031 exchange?
Right. There has to be a company that's called a qualified intermediary. There's several in town that we refer to folks, but that is all they do. That's all they do is those real estate transactions. We coach people through the process. We do the tax projections. We help them understand from beginning to end how it works, how it impacts them, what they need to do for tax purposes. So that way, between us and what a QI does, they have everything under control.
Makes sense. But yeah. So a lot of people have equity right now, I can imagine. So, I mean, if you're looking to sell your investments, sit with your CPA, then get the 1031.
Right. Now, the real trick is, and we've had this happen, sometimes 1031 exchanges fail. Sometimes you sell the property intending to contribute and be part of a 1031, and you can't identify a property to utilize. So then you just basically cash out the escrow account from the QI, and then just becomes a taxable transaction. No different than if you just sold it directly. So that does happen from time to time. QIs don't charge a ton for their service. So it's not like you're going to spend 10 grand for them to do it. It's like, $700, $1,000, $1,200, something like that. It's just not a lot of money you have to worry about. So
is there any like extensions? Like, it's not, if a deal doesn't go through, it's outside of your control. Nope. It can be another 30 days, nothing like that, huh?
Nope, because the QI can't do that. So they will, if you can't close in 180 days, they're pushing your money out and saying, have a nice day.
Got it.
On day 181, they don't have a choice. And there's no exceptions, there's no extensions, there's no nothing on that.
Love it. So if you guys have any questions for Seth in regards to, him being a CPA, taxes, the Inflation Reduction Act, anything out there that you want to get off your mind or get answered, if you're on Instagram, Facebook, we got about 5 minutes left. We want to make sure we get your questions answered, and we've got quite a few people here. So, Seth, man, I really appreciate it. A lot of great information. What else can we talk about here in regards to I got a lot of papers on the Inflation Reduction Act. I was like, and it also seems like it's really just targeted to a big business, like multi-family.
Exactly. There's not a lot that applies other than the fear factor. That's really what applies to smaller business owners. It's just the fear of, upgraded compliance. We've had the lowest historical audit rates ever the last handful of years because the IRS is so understaffed. So we've been living in this glory time of it, just very little happens there. They call them desk audits. They'll send you letters. They'll ask for particular information. There's really nothing too particularly crazy. One of the things I did want to bring up, and I don't know if Mick has actually talked about this in the past or not, so I just want to reiterate it, is we do look at the LLC structuring for rental owners. I was talking to someone yesterday who has 2 properties looking to add a third. So we encourage people to have every single rental property in its own LLC to insulate it, right? We call it risk compartmentalization. Keep it there so if anything happens, nothing blows up and gets to the rest of the financial life of the owner. But that does require you to keep a separate bank account and separate ledger for that property. You have 4 or 5 or 6 properties, having a separate bank account gets to be a real pain in the butt. It's hard. So you are permitted to do a parent company that owns all the LLCs. And so it owns all the LLCs that own all the properties. And then you can have one checkbook at the parent level. The question for people is, when does it make sense to do that? Right? I tell real estate owners 3 or more properties when it starts to make sense. You can use that parent entity as more of an active business at that point, because 3 or more has enough hours commitment and enough business going to justify that it's becoming more of an active enterprise. So then you can start to trip in some of those other office expenses and cell phone and vehicle and all that when you have enough volume of transactions going on. So you can have one bank account at that top entity level that manages all your real estate, so long as you keep a separate ledger of income and expense for each property. Then it doesn't violate the LLC's protection of and keeping that risk compartmentalized between them.
And if I can add to that, I mean, what you just said is huge, because we had a few episodes with another investor about a month ago talked about being bankable. Okay, so when I submit my million LLCs to the underwriter at Bank of America, they throw the papers up in the air and they cancel the account, and I don't get it. I don't get a loan because they're like, who's this partner on this LLC? Who's that JV partner? Where's that K1? Where's those bank accounts? Now I got 500 bank statements. I'm trying to, so what you're saying makes you more bankable.
Oh, for sure.
It makes it simpler for everybody to allow you to get more investment loans. And if you have good credit, and you got income coming in from multiple LLCs and flips, like, I mean, it's smart. So definitely call Seth, get with a professional. Would you call it a holding company or?
Yeah, no, exactly. We'll call it a holding company, but I want it to appear more active than that, right? So
Yeah.
we won't, when we do the coding on it, we do it as real estate investments, right? I try to avoid anything that would give any indication that this was not an actively managed entity.
Yep.
Right. So I have clients that do their last name like Smith Holdings LLC, which is fine. You can do that. But it is a business at that point. It's truly a business of owning and managing real estate. And
That's a brilliant, it's smart. I'm actually working on some stuff with Mick now. And if you're looking for an LLC, Mick and Azria, we in Focus, we have a great offering for getting your LLC created. So if you go to the front page, Molly, maybe you could put the link in the chat. If you're front page of our website, right in the middle of the front page, go to the Focus logo, and for $385 with an operating agreement, you can get a basic LLC created by a real estate attorney. It's better than LegalZoom, better pricing than LegalZoom, and all that stuff. So get a professional to do it. If you go on their website, I think it's like $685 if you went straight directly through them. So you take advantage of your Azria account to do that.
I'll tell you, doing your own LLC on LegalZoom is like doing your own taxes on TurboTax or going to Edward Jones for your investments. You can't ask the box. You want to have a professional like Mick being able to take care of you to do those things. And that's where we come into play for clients. Like we are professionals of what we do. You go to do your own tax return, you're on TurboTax, just like you said before. I can't ask that question. It doesn't know what to tell me. And what history always tells you, when you do ask the question, it doesn't come out correctly because it doesn't really get the context of what you're asking. And so you end up putting it in the wrong place, not knowing you're putting it in the wrong place.
That's a great one. You can't ask the box. That's a good one. Yeah, man. And Mick will even talk to you. We'll respect his time, but if you had a question, you'll get it answered as well. So question on Instagram: how do we set up an in-person meeting with you, Seth?
Just email me with some basic information, and then we work on doing that. I manage my own calendar for the most part. So if you have questions, we can either schedule a phone call, Zoom, or a meeting if it warrants that, and go from there.
Yeah. Yep. Seth at focuscompanies.com. And you can see his information on the screen. Just shoot him an email. Tell him you're an Azria member. He'll take care of you. Well, he takes care of everybody regardless, but so there we are. Any last questions? Let me check the chat box. Oh yeah, I got it from Diamond Right. As Roger said, as a real estate investor, when should I get a CPA? Before or after my first deal?
I think it really depends on the complexity of your particular situation, but I would definitely say before filing taxes for that first year would be the time to engage a professional.
And there's, like when we deal with like new people, right? They always want to get their ducks in a row before they actually do it. I'd rather you just go out there and do it and then work on it, right? But if it's a rental property, Roger, I know Roger, and I know he's looking to get some rentals, but for liability reasons and stuff, at some point, sooner than later, you probably will want that property in an LLC, which makes me have a question, right? So you have someone, let's say Roger, he's qualified for a loan. It's under his personal name now, so he has to go out and buy that house under his name, right? So then he's gonna have to get it into the LLC. So what's the experience around quit claiming or that process?
It's pretty simple. So yeah, unfortunately, you have to buy the property personally. They won't let you buy it as part of an LLC unless it's a cash deal. As long as you're financing it as an investment property, not as a primary residence, which some people try to skirt around and do. As long as it's an investment property, then once the property closes, then you can deed it into your LLC, right? Sam on our team that does our estate and trust work also does deeds. So I was just talking to him this morning, and he said it's $200 for him to draft the deed and the filing fees to do it for you done. And title companies generally won't do it. So we can do that as part of our service Focus and get that accomplished for somebody. So when you create your LLC, then we can do the deeding for you and get it in there, and then you're good to go.
Love it. So yeah, have a professional do it. I did it recently. Make sure you get title insurance. If the change, I don't know, talk to your title company about that, because when you buy it in your name, you get title insurance. If you switch the name of the property, I don't know if you lose that title policy or not. I don't know if you know Seth or talk to a
Well,
title company.
it's funny. I've been told by people that are title professionals will tell me to do a special warranty deed and not a quit claim deed, but not everybody agrees with that. So I think that's definitely an attorney question to say, how does this work and what's the best thing for me in that particular process? It doesn't say it would void your policy if you did a quit claim. It says it could. And I don't know what the exceptions are that would make it where it could or where it could not. So
I definitely, that's why here at Esria, we have all the professionals, the attorneys, CPA, title companies, hard money lenders. We have all these people already here for you to chime in and ask questions. I personally got stuck when I did a quit claim. I didn't pay attention to the deeds and the type of deeds, and I almost lost my policy. So don't make my mistakes. Learn from this community and pick up a phone, 5-minute phone call, man, save you. Because a tax lien came back on me a year later, and they tried to they did foreclose, and I was able to stop it. So never in the world would I ever thought that would happen because I went through title. You still got to make that phone call, protect yourself. So
I will share this. I've seen this happen once where, I tell clients, save every real estate transaction paperwork in perpetuity. Always don't. It might be a 5-year rule for tax papers and all that sort of stuff, but when you buy, sell, or refinance, save the package, scan it in, and get rid of the paperwork, but have it. We had a client years ago, 2 or 3 years ago, an elderly lady inherits her mom's house. They found a title defect, and it looked like there was a lien that was never paid off on the property. And the time that it was purchased before that, it never got properly recorded and cleared. So it took a monumental lift to make that happen.
wow.
So it's just always that reminder, save that stuff, because you have the title insurance policy with your paperwork. You have your closing statement. You have all that information so you can prove, hey, I bought this property or I refinanced this property. Here's a clean title policy. Here's everything done. Not my fault. But it's up to you then to fight that, if just like what happened to you. So
Yeah, I learn as we go. I still learn in the 12 years. I'm always learning these little things. They sound so simple. This isn't a hobby, everybody. We're buying real estate to build wealth, to change the trajectory of our future, our family's future. Don't take it lightly and just skim over these important things like with attorneys and CPAs. I know it's costly, but it's worth it up front to save that future headache. Learned that the hard way plenty of times. So, man, any last words for us, Seth?
no, just be diligent, pay attention, keep good records, be nice to your CPA.
Yes.
But just diligence and proper record keeping is like the best advice I can give anybody, especially if they're just starting into this world of being a real estate business owner. So
awesome. Diamond Right Construction said they'll be giving you a call. Love it. Every Wednesday, 12 o'clock on Zoom, Facebook, and Instagram. We are here with special guests and their masters in their own strategies and industries. So thank you, Seth, from Focus Companies, for being here. As always, I love the whole company, everyone there. I can't wait for hopefully I still get an invite to the Christmas party again. I really enjoyed last year.
I'll put in a good word for you.
All right. I'll take it. +5 this time. That's good. Love it, man. Thanks for being here. The recording will be on Facebook and Instagram if you guys want to watch this over. Once again, see everyone next week.
Thanks.
Thanks, Seth.